Chris, great to have you on. I appreciate it. I know it's early. When we look at the entirety of what happened, was it all China or was it China plus other stuff?
Hey, Brian. Yeah, I certainly think it was China plus other stuff. It was great to be able to point to one thing for the sell-off yesterday, but keep in mind that expiration on Friday was one of the biggest expirations of all time. That's a huge liquidity event, and then you turn the page to Monday, much less liquidity on the back of that event. So that could be having an impact. Like I said, enough has been weighing in on markets, and we shouldn't really be surprised to see a move like we saw yesterday. It felt like more of a shock because we hadn't seen one in so long, but it was not even a one standard deviation move by the end of the day. We haven't had a two standard deviation. I'm sorry, it wasn't even a two standard deviation move by the end of the day. We haven't had a two standard deviation move in over 7 months. We would expect to see, 5 or 6 over that type of a span. So really, it was partly the surprise of the move
Yeah.
because we haven't seen a move like that in a while. But it should be somewhat expected to see a move like that from time to time.
And that's it. And I know I've bored our viewers to tears the last few years talking about things like market structure, negative gamma options positioning. It's 5:45 in the morning. I know nobody probably wants to hear it as they're waking up. But when you look at the way the market has gone up without these big drops, of course, minus the COVID thing, that was its own thing, just this steady climb up, how did the options positioning factor into all of this? This idea of negative gamma just the rate of change of price movements. How did options positioning factor into the speed of this decline? And by the way, the other ones that we have seen the last few years.
Sure. Buying calls, long calls, that's been a real popular strategy, as investors, retail or institutional are buying calls. And it's mostly on the equity level, but obviously that has a huge impact. As they're buying calls and market makers are selling them, then the market makers go out and buy stock. Now, that's a gradual, slow process. You see those types of grinding moves higher. However, when the market does sell off, all of a sudden, if those calls that the market makers are short are not in the money anymore, then the market makers all at the same time have to go out there and sell some stock. So you suddenly can see those sharp moves lower on the down days because market makers are unwinding their positions, and that juxtaposes with the very slow grind higher incrementally as investors are buying calls on the way up.
This is a really, really important point that you are making, because when you look at the way that market structure, whether it's the algos, the market makers, ETFs, options, has evolved in really just the last 5 years, is that kind of, Chris, going forward, our new reality? And I was trying to explain it to my family last night. I don't know, this is maybe stupid, tell me. I describe it as a treadmill, right, with a slight incline. You're kind of plodding away on this treadmill with a slight incline, and every once in a while, you fall off. You catch a shoelace and you go down. The new market is kind of like that. That the idea that we're going to grind higher, have a sharp, steep, fast, maybe embarrassing drop, grind higher. Is that kind of our new reality?
Yeah, I mean, I think there's certainly something to that. I think there's the argument that, there really is nowhere else to go if you look at, U.S. Treasury yields and what, other places that you can put your money besides the stock market right now. So, that's a part of it. You don't want to be the last person out the door when we do have those sell-offs. And, you mentioned it's early, so we don't want to dig too much into market skew, but that's the way that S&P skew is pricing the market very relatively low volatility right around the options that are right around where the market's trading, but further out of the money down on the downside, that volatility is very high. And it's almost like the market's telling you, okay, 9 times out of 10 or 98 times out of 100, the dip is going to be bought.
Yep.
But that 1 or 2 times that the dip that it breaks through the dip buyers, we can see some real moves to the downside.